Now, please understand that as part of the business degree program, you will have the chance to take both accounting 1 and 2. So you'll learn a lot of these concepts in a much deeper level. Today we're going to focus on accounting really from a business perspective. Even if you don't plan to be an accountant or you don't love these classes, this is something where you need to understand the language of business. So it's important to understand the concepts we'll talk about today. I'm going to try to introduce them to you in terms of a business manager who is not an accountant, kind of what you need to know to help make sure that your business does perform well and that you understand what's going on. So we're going to talk today about what exactly accounting is. We'll also talk about its users. We'll identify the foundation of the system of accounting, and we'll outline the steps in the accounting cycle as well as the accounting equation. We'll look at some of the major financial statements, components of each, and their uses. We'll also explore the purpose of financial ratio analysis and the use for various ratios. So why does this matter? Maybe you don't plan to be an accountant. It's still important to understand this information. Let's look at this example with Billy Joel. He created that song, The Piano Man, had 33 top 40 hits, 23 Grammy nominations, and many other accomplishments you can learn more about at this site. He shouldn't have found himself on the verge of bankruptcy in the 1980s, but that's where he was. He filed a $90 million lawsuit against his former manager, Frank Weber, for mishandling his income and expenses. Even if you have an understanding how to look at financial statements between multiple periods, what you'll learn today in this class and hopefully in your accounting classes would have helped a lot for Billy Joel, because you want to make sure that you understand what those statements are really saying and what to look for and what is a red flag so you don't end up in the same boat. Knowing what should have appeared on those statements might have helped Billy Joel spot those gaps in the missing information, spot red flags to ask the right questions so you don't find your business or yourself in the same situation as Billy Joel found himself in. So let's take a look further into accounting. This is the process of measuring, interpreting, and communicating financial information to enable people both in and outside of a firm to make just more informed decisions. It's known as the language of business. We're looking at the activities of the business from a financial standpoint to make better managerial decisions. So first of all, there's financing activities. Providing those necessary funds to start the business and expand it after it begins to operate. They're simple questions. Again, even if you don't want to be an accountant, how much profit can you take out of your business? You might be profiting $10,000 a month, but maybe you have plans to expand, so you want to be saving, putting some of those profits back into the business and saving for the next location rather than into your pocket. Or maybe you need to be saving because you have a piece of equipment that might only be lasting 5 years that you're going to need to replace that could cost $10,000. So you want to be thinking about, how much money should I be investing in the business, taking out of the business, and those are all good conversations to have, and accounting will help you understand that. Likewise, investing activities, providing valuable assets to a required business to help run the business, thinking about should I invest in, for a clothing company, my own printing machine, or should I distribute that out to a supplier? You can save some money if you invest in the equipment on your own, but it could be a large upfront cost. So determining what to invest your money in. Should I spend that $1,000 for a marketing campaign on Facebook this month? Will that actually bring in enough people to make it worthwhile? Another example of activities in business that involve this accounting that's so important are operating activities. Focusing on selling goods and services, but also considering expenses. To really have sound financial management. Looking at things like how much does it cost me to hire a new employee, and then once I have that employee, how can I best utilize that employee on the job? Thinking about when you're selling a good, what price to sell that good at, if there's a lower way to make the goods at a lower cost and then be able to sell a higher price, you can make more money. That's your profit margin we'll talk more about later. So these 3 activities, financing, investing, and operating activities, they're business activities that are going to be important to you, whether you're an accountant or not. And so having this understanding of what we'll talk about today will help inform your decisions in those key areas. And this matters for people both in and outside of the firm. They're going to rely on this information. So when we talk about management accountants, these are internal users. And they're thinking about things like, for an owner, should we sell some of our assets next year? For a manager, did our prices really make sure we got the best profits this year? Were they too high that people were not buying? Were they too low that we weren't making enough on each sale? Thinking about things like if you can afford to expand, whether you should. For external users, owners are thinking, did we make a good profit, that it really is helpful for our investors? Managers, can we afford to give people dividends? If someone invested in the company, should we give them something in return? Government agencies, are you reporting correct and complete information? And then investors and creditors. An investor, if someone's about to invest in your company, they want to see what financial situation you're in. It's good for you to have an understanding of what that could be. And employees as well. Thinking about things like how much benefits to give an employee, whether to contribute to things like a pension fund or retirement for your employees. So they're all important considerations that utilize some of this accounting language we'll be talking about today. So let's talk about the foundation of the accounting system. One of the big terms to be familiar with is what's known as GAAP, the Generally Accepted Accounting Principles. This looks at the general conventions, rules, and procedures for thinking about acceptable accounting practices at a particular time. Now, there's a Financial Accounting Standards Board known as FASB that's primarily responsible for evaluating, setting, or modifying GAAP in the United States. So they make changes to those policies and procedures so we can have some consistency in how accountants are collecting information and reporting information. For example, if I tell you if it's 51.60 to round up to $52, that can make a big difference when we're talking about multi-million-dollar businesses. So how you round up or round down can make big changes. So having some consistency in that can be a good accounting practice to make sure that we're looking at apples to apples when we're comparing firms. Now, as part of that foundation to the accounting system, we've heard this term before. I want to talk about the Sarbanes-Oxley Act, or the SOX Act. This came about in about 2002 as a result of some major scandals such as Enron. Now, the idea here is to try to help put some requirements in place to avoid fraud in the accounting field and to make sure that people are reporting complete and accurate information. Now, some types of requirements under Sarbanes-Oxley that make this type of information important for you to be aware of, even if you never want to be an accountant, is that publicly traded firms that have stock on, the New York Stock Exchange, they have to post these financial statements to the public. And their managers, their executives, have to be aware of what's in the statement and signing off on it. So you can't just do what they did, when Enron was going on and say, I'm ignorant, I'm not an accountant, I had no idea that these financial statements were not right. No, they expect you as an executive, as a chief executive officer, even if you don't have an accounting background, to sign off and say, I understand these statements and they seem to be right. And this is something you should be able to do. If you have a financial statement saying your company is making tons of money when you know you've been spending quite a bit and that you've lost some major clients, that's a red flag, and that's something you should know to look into. And having the information we're talking about today will help. So let's talk about the accounting cycle. This is the set of activities involved in taking this information and transactions and turning it into those financial statements. I'm going to zoom in here for you to see. It starts with this, looking at what we call source documents. Someone sends you an invoice, you pay that invoice, they give you a receipt. That turns into a transaction where you'll either debit or credit. And again, you'll learn more about this, how to debit and credit those accounts in your accounting classes. That all gets transcribed into each transaction into these general journals, which they post to something called a ledger. Then we get a trial balance, they prepare a worksheet, and they turn those into income statements, balance sheet, and ultimately a general journal ledger, and we post a closing trial balance, all trying to reconcile this information. We're looking at all the money coming in and going out and really sorting that information and ultimately turning it into these statements, which we'll learn more about now. Smaller businesses, let me zoom in here for you to see this. Smaller businesses generally use QuickBooks to electronically manage this process, and larger firms often have software for their specific companies, made by companies such as Oracle, to help maintain this information. You will have to go in and, for example, as a business manager, even if you're not an accountant, you can save some money by being able to reconcile, here's the money coming in and out of my bank account, here's what's stated in QuickBooks, and do these match up. Now, something to be familiar with in terms of accounting as a business person is the difference between cash and accrual accounting. So understanding these terms and which your firm's using and which firm your firm should be using. When I started working with Workplace Fairness as a nonprofit organization, they were doing their accounting on a cash basis, and it was important for them to transition to an accrual basis if they wanted to start obtaining grants. So it's important to know when a business is required to use accrual accounting. There's more information here, and to think about what's right for your firm. So the difference between cash basis versus accrual basis accounting, again, I like to try to keep this accounting language more in a business terms for you. Here for cash basis, we're looking at revenues that are recognized when you receive cash. So you receive $100 for a customer, that gets reported, okay? And when you pay out cash, that gets reported. So let's say you have a new customer and they've agreed to pay you $10,000 within 30 days. Under cash basis accounting, you wouldn't get to recognize that revenue immediately. You'd have to wait, when they pay you on day 28, that's when you record it, when it was actually paid. So we know it's actually there. In accrual basis, you recognize that revenue when it's earned. So as soon as you say, hey, 30 days from now, I'll be getting this $10,000, you can recognize that as a revenue. Okay, and likewise, if you owe somebody $1,000, you're going to recognize that right away, and you don't have to wait 10 days until you actually pay it. So it helps give you a better understanding of what money could be coming in the future and money that's really been spent already, even if it has not been paid. So they can both have different benefits. Again, under accrual accounting, we're looking at revenues and expenses as they occur, not necessarily when cash changes hands. Under that cash accounting system, you don't report any income or expenses until the cash changes hands. So in general, most businesses end up using accrual accounting, but individuals and small businesses tend to use that cash method. You just want to be careful about it. It can lead to kind of gaming the system. So for example, maybe you delay paying that $1,000 to make it look like you have the extra $1,000 in profits, when really you owe that money and need to pay it. Now the accounting equation is an important part of the accounting field because it shows your firm's financial position at any time. Again, even if you don't want to be an accountant, it's important to know whether or not your firm's making money and what the real financial state of your firm is at a given time. So the accounting equation can be very valuable. But before I dive into it, the accounting equation is assets equals liabilities plus owner's equity. A nice way to think of this in business terms, assets, or what we have, equal what we owe, liabilities, plus what's left. We're looking at the things we have and how we got them. That's really what it comes down to. So the example that I like to give is in terms of a car. A car is an asset. It's something that you have. Imagine you have a car that's worth $20,000. Okay, and I have a car worth $20,000. Now your car you bought with savings in your bank account. You spent about $15,000 of your savings and you took out a $5,000 loan. So the asset that you have is the same as what I have. It's a $20,000 car. It's worth $20,000. You owe $5,000 on it, and you invested $15,000. Now that really means that you have this $20,000 asset. You owe $5,000. You pay that $5,000 loan. What you have left, your owner's equity, is really $15,000. Now again, I have that same asset. It's $20,000. But I got it almost fully on a loan. I put down $2,000 and I have a loan $18,000 worth. If I go to sell that asset, that thing I have, I pay off what I owe, my liability of $18,000. What I actually have left is $2,000. Now what you have left was $15,000. We both have the same car. Both cars are worth $20,000, but we see then that they have different value. Hey, because I have so much debt, I have so many liabilities, what I owe on it, my actual equity in that car is only, a couple $1,000s. Whereas for you, you have less debt in that asset, you actually have a lot more money left. There's more equity in it. So while I don't have $20,000 in my pocket, this asset, this thing I have, is worth much less than this thing that you have. We both have a car. We want to look at how much debt we have in that thing we have to figure out what the real financial state is. So hopefully that illustrates to you the importance of this accounting equation. A firm can have a ton of assets, but if they borrowed a lot of money to get those assets, they don't really have a lot of equity. Let's take a look at that further. So again, an asset is what we have, it's what we own, and it can be anything of value owned or leased by a business. So you might be thinking of things that are more tangible, things like equipment, buildings, inventory. Again, it's not that cash in your pocket that you're thinking of, but it has value. For example, if you buy an office space, that physical location has value. If the business shuts down, you'll be able to eventually, hopefully, sell off that space. So it does have some value to it. The inventory, again, if your business closes down and you have a bunch of computers on the shelf, the computers have some value. You can sell them for something. Now, there are also what's known as intangible assets, these things that have value that we can't necessarily hold in our hand or see. Something like a patent or a trademark. Now, that's a legal ability to kind of really have a competitive edge. With a patent, you invented something and you have a limited amount of time, but some time, to be the exclusive seller of it. Trademarks provide some value because you legally have a brand that you can protect and not have others using. So there can be some value to these intangible assets as well, things we own. Now again, that equals the debt we have and what's left, the equity, the liabilities plus the equity. So liabilities are claims against those assets by a creditor. It's what you owe for that asset. This can be something like a loan to a bank or any other long-term debt. It can also be things like wages and salaries you owe to your employees. Anything that you owe to obtain that asset is going to be a liability, such that if you sold it, we need to pay off all that debt, the equity is going to be what's left. This is the owner's really initial investment. If you put that $2,000 down or $15,000 down on that car, that's your initial investment. And then any profits that were not paid to the owner over time in the form of cash dividends, it's what's left off. After we pay all that debt, all the loans, all the things we owe, what's going to be left in that asset? What value do we have? So let's take a look at this again with an activity. Your company, like many, needs a business loan. You borrow $100,000 from Bank of America to help get your business started. How would you state this using the accounting equation? When a company borrows money from a bank, their assets are going to increase. But so are their liabilities. So it's kind of this double-sided thing where we want it to equal out. That means under assets, you're going to put $100,000, but you also need to say that that equals your liabilities plus owner's equity. Your liability, what you owe, is $100,000, which means there's zero equity. It's really great that you borrowed that money. You have that money then as an asset. It's something you own, but you owe it back at that point. So you do have some liability as well. Here's another example. Your company needs to purchase inventory worth $20,000, and when you do so, you receive a bill, or what we call an invoice, from a company stating your payment will be due in 90 days. How would you state this in the accounting equation? When a company purchases inventory and owes a bill, that means they have assets that increase. So here we have inventory worth $20,000. That's something we have. That's going to equal our liabilities of $20,000 for the invoice and $0 in equity. Again, if we sold off that inventory, we'd have to pay off that debt. We really don't have any value left. If a company keeps accurate records, this equation will always be in balance, meaning that left side, what we have, should always equal that right side. The balance is maintained because every business transaction affects at least two of a company's accounts. Since there are two or more accounts affected by every transaction, we often call this accounting system a double entry accounting. Again, we record the value we got, the inventory on one side of the accounting equations as assets, or what we have, and then we're also going to record the other side of the accounting equation, whether or not that's something we owe money on or have equity in, for a double entry. So there are many financial statements you can look at for a firm. Again, under Sarbanes-Oxley, we have to post some of these for publicly traded organizations, but a lot of companies volunteer this information. It might be that you're at a smaller firm who's paying you an incentive as part of the company. You're going to profit some. You get a little bit of profit sharing. So you want to know whether or not they're profitable. So it's important to understand what these financial statements are showing and what sort of red flags to look for. Like I said earlier, as a manager, if you know that you've had a really good profit situation, you should see that reflected in your statements. And by looking at these statements, you can learn a lot. You can see, hey, we have a lot of revenue coming in, but a lot of expenses going out. So our profit ultimately is pretty small. You can look at ways to cut down those expenses then, or maybe somehow increase your revenue by either increasing the size of your market or changing prices. So by analyzing this information, it can help make you make better strategic decisions about your business. I'm going to show you some of the things to look for in terms of red flags. Again, even if you don't want to be an accountant, you should understand what's in these statements, what they're showing you, the purpose of them. And it's the same for our exams. What is the purpose of this statement? Not necessarily how to create it. You'll learn that in your accounting classes. And then being able to understand what are some areas of caution to look for and just ask more questions. So again, these statements provide managers with information for evaluating your ability to meet certain obligations and needs. For example, if you're looking to see whether you can invest in a new location, you need to understand whether or not the company has enough money, to do that. What type of financial health the organization has. So we're going to look today at the balance sheet, the income statement, the statement of owner's equity, and the statement of cash flows, which again help give you a basis to make those decisions. As I mentioned, public companies are required to report their financial statements at the end of each 3-month period, or quarterly is what we say, or as well as at the end of each fiscal year. So we're getting incremental information as well as information on a yearly basis. And the idea there is so I can invest in a company knowing that what they're representing as their profits are actually accurate. In a company like Enron, when they're saying we have all this profit and we're doing so well, and it turns out they have all this debt that was hidden that they weren't sharing with the public, you're investing in them thinking their stock has lots of value because the company has great financial health, and really they didn't. And so Sarbanes-Oxley is put in place to help fix that, to help disclose accurate and complete information to the public. Now, why would someone lie on an income statement? Well, if your profits look better, your stock value is likely higher, and that can be better for the performance of the company as a whole. So there can be some incentive for people to lie about what the profits look like on these statements. And so it's important to understand where some of those errors can occur. For samples of what's known as an annual report, where you can seize this information for a publicly traded organization, as well as federal agencies having to report similar information, you can look at these two different links here. I'm going to show one on the screen now for General Mills. Now, a company like General Mills that's publicly traded every year will post, again, quarterly information, but also annual information, not just about the financial situation in the company, but also just their overall objectives and how the firm's performing. Okay, so let's take a look at the 2017 annual report. Here you'll often see on the front of the report, some of their key areas and brands that make up their product mix are noted on the screen. So you can see things like Annie's, Nesquik. You can see some of their cereals. Their Yoplait has been really big for them. And each of these key areas, they talk to their shareholders and tell them how the firm's going, some of their priorities, their strategic planning, as well as their performance. So you can look at their financial summary, and we can see their financial statements that we'll be talking about today. So you can see examples of these. Really quickly, we can see their operating profit margin, so the money going in their pocket, their percent of net sales. You can see that increasing really quickly. This can help you if you just are trying to decide whether or not to invest. Seeing that they're doing well. Seeing their cash flow. Okay, and their working capital. All these data points they're talking about, in their financial summary here to help you in terms of making decisions. I want to show you some of the financial statements we're going to look at. So here's their statement of earnings. And here's their comprehensive income. So a lot of the statements we're talking about today you can see reflected on the screen here to get some samples. So I encourage you to dive deeper, take a look at some of the annual reports for companies that you're interested in, and try to understand how are they performing. Looking at their financial data and trying to decide things like, are their net sales, here we see their sales as a whole increasing, but that doesn't necessarily mean that the company's making more money. Sales could be increasing, but if expenses went up, they might be making less profits. So looking at these numbers and understanding, is the business performing well? Do they have a lot of cash flow? Should they? And it's helpful in doing that to compare annual reports between companies in similar industries. Okay, that way we can see some of these ratios in these financial statements. If you're just looking at them for the one business, are not as helpful. It's helpful to see how a business should be performing in the industry as a whole. And that's going to vary significantly from industry to industry. So take a look at those. You can take a look at some of the federal reports that are out there. They call them agency financial reports. Usually it's going to be the top level executive or the secretary of those agencies talking about how they've been meeting their goals and how they're performing overall in a letter to the interested stakeholders, whether it's the shareholders or the public for the federal agencies. And then they're going to share some of these statements we're talking about now to disclose how the company's performing. So the first one we'll talk about today is what's known as the balance sheet. This is a statement of a firm's financial position on a particular date. A good way to help you remember this is to think of a picture. Okay, I'm taking a picture. So the illustration I like to give in terms of a classroom. Imagine there's 30 students in a class, and I'm grading your attendance in class, and I take a picture on a day that you happen to be absent. You've been there all semester long, but I snap the picture on the day that you were absent from class and give you 0 credit for attendance. How would you feel about that? Doesn't seem fair, right? So the balance sheet's going to give you a good snapshot and some helpful information on the firm, but we'll talk more about the income statement later on, or what's known as the profit and loss statement. That's going to give you better information over a longer period, so you might not get that skewed information. If we just take the snapshot, things could look really good, but if we're looking at the period as a whole, we're looking at your attendance as a whole in the class, it could be a very different story. So here's what the balance sheet does. There's a video tutorial, by the way, for a lot of the information we're talking about today. For those of you that want to dive deeper, you can take a look at those video tutorials to help learn more about the balance sheet. Again, you'll be diving deeper into this in your accounting classes, so we're just focusing on it today at a high level and for a business perspective, how it can be helpful to you. So on the balance sheet, it actually follows that accounting equation we just introduced. So on the left side are assets of the firm, and they're going to show those in descending order of liquidity. Okay, how quickly you can turn something into cash that you can use. Okay, it's great if you have a $3 million home, but that doesn't mean you have $3 million in your pocket if you need to pay someone $3 million the next day. It could take you 3 years to sell that home. On the right side are claims against the firm, so liabilities and owner's equity listed in the order in which they're due. Okay, we're looking at the difference between assets and liabilities to find that owner's equity. So let's take a look at the balance sheet. Now here's an example of what that can look like. Here we see assets starting with things like cash on hand, and we see it going, based on what's most liquid, cash, and what's not as liquid. Again, inventory and supplies that you have do have some value. You could sell those. We see investments here, property, plant, and equipment listed. We see that intangible assets we were talking about, things like goodwill associated with the brand value your company has. So we see the total assets, the total things they have, at $770,000. Now we look at the liabilities based on what's coming due first, and what's left, that stockholders' equity, and that should, we talked about the double entry accounting, that should balance out to $770,000 as well. We're looking at how much of what we have of that $770,000 we owe. Here you'll see that's $481,000, and then down here what's left then would be that $289,000. So again, we see that accounting equation reflected in the balance sheet, but keep in mind it's a snapshot, it's a picture, so it doesn't tell us the longer story of the business. It might, just like you missing 1 day of class doesn't represent the whole semester, this might not represent the whole story. So we need to look at the income statement as well. This is looking at a financial record of your firm's revenues, money coming in, expenses, money going out, and ultimately what's left, the profits, over a longer period of time. Usually it'll be a quarter or a year, so 3 months or a year. Again, there's a video tutorial here for you, some great video tutorials on Investopedia.com I encourage you to take a look at. The income statement is also known as the profit and loss statement, and this helps decision makers focus on the overall revenue, the money coming in, the costs associated with those revenues, ultimately leading to better profits. So it helps you calculate some of the financial ratios to plan and control activities we'll talk about later on. It begins with total money coming in, looks at what's going out, so we can see whether or not things have been profitable over the year. If you see, for example, you have really high revenues, but there's a lot of money coming out, so profits are going down, you might want to look at ways to lower your expenses as a manager. The bottom line of the income statement reflects net income after taxes, so you can see what could go into your pocket or should we invest it. So it helps give you an understanding of really how much money your firm is making. Let's take a look at that. Again, this is not just the snapshot like we see in the balance sheet, this is the whole story, this is the video, and that's why you see the film Let me go back here. The film noted on the bottom of the screen. You notice the whole video. It's not just that picture. So it would tell me your entire attendance for this semester, not just that one snapshot. So here's a sample. We'll see here revenue and gains. So here's money coming in for products being sold. If there's other revenues from interest or any other money coming in, that would be here. We're looking at expenses and losses, so things like the costs associated with manufacturing those products to sell them to bring in that revenue. Let's say there was a lawsuit, any marketing, any types of expenses associated with the business. So we're going to take that $108,000 that went in. We're going to look at all the money that went out, $90,000. We see we actually were left with $18,000 over that year in our pocket. In this sample income statement, they've chosen to do 5 months, which is different. Most firms you'll see, 3 months, 1 year. But it's important to be able to do this and understand. Here you should see, again, simple math. This number minus this number should equal this one. And so if you see, 108,000 minus 90,000 equals 20,000, whether you know accounting or not, you should be able to do that addition and subtraction and looking at this bottom line say, hey, that doesn't add up right. And yeah, maybe that doesn't seem like a lot when it's $2,000, but when we're talking about multi-million-dollar financial statements for these huge companies, if you're off by 1 or 2 numbers, that makes a big difference. The number here is 5, minus 3, and we're saying there's 4 left over. No, it should be 2. So we just messed up a little bit, but we're talking now $2 million that's off. So you really want to be careful about that. I saw that working with some clients, back in the day when I was doing some consulting work. We're looking at these types of statements, and we saw people make simple errors like that. 2 plus 2 equals 5, and maybe they weren't intending to inflate the income, but because we were talking in millions, that one simple accounting error led to a really big misstatement of what the actual profits were. So it's important to pay attention to that. And again, you don't need to know a lot about accounting to look at this and say, 108,000 money coming in, expenses money coming out, here's what's left over, and make sure those numbers add up right. Now, as a part of the income statement, you'll notice here that it starts with the money coming in, your sales revenues. Each time you sell something like this stapler, let's say you sell this for $10, that's $10 that comes in, that's revenue. But we need to take out the expense, so the cost of the goods sold. To make this stapler, it cost me $6. So really there's $4 profit each time I sell the stapler. And so looking at that, it's important to be able to basically determine what the revenue could be. What is the sales potential to determine whether or not you could be profitable? If I'm only going to make $4 each time I sell these, how many of these do I need to sell to make money, given all the expenses associated with the business? And that's what's known as a forecasting technique. So this is something that you should be familiar with to be able to forecast the amount of money that could come into the business. One of the major ones in terms of a forecasting technique is what's known as the competitive approach. Here you simply look at other similar companies as a benchmark. You look at similar companies in similar areas and see what information you can discover. Now sometimes that's about just asking. For instance, you have an ice cream shop in Rockville, Maryland, just go to an ice cream shop in Silver Spring with kind of a similar population and ask them for sales information. As long as they're not a direct competitor, they'll help you. You'd be surprised how simple this is, just asking someone in the same field for advice. Often they'll be more helpful, again, if you're not cutting into their market. Someone selling ice cream in Rockville, probably I'm not going to drive all the way from the Rockville ice cream shop to go get ice cream in Silver Spring. It's not hurting their customers. They might like helping someone in the community. The other thing you can do is just look for data, especially if it's a franchise. There can be a lot of data on the web. So if you run a Google search and just look for this information, you can find sample business plans and additional business informational sites that have some data that can also serve as a resource. Okay, so again, benchmarking against the competition. Asking the competition for information can help you understand what your possible sales could be. So for example, my sister and my sister-in-law were my sister-in-law, she started a daycare company a long time ago. She started a daycare in her home, and so she knew what those profits looked like each year. And so when my sister wanted to open another daycare business, my sister-in-law owned one in DC, my sister wanted to open one in Bethesda. Someone who's bringing their child to a DC daycare is unlikely to want to drive to a Bethesda daycare. So my sister wasn't stealing any business. She was able to just ask my sister-in-law, what type of money she was able to bring in and decide whether or not it was a good business idea to start another daycare in the Bethesda area. She was able to have an idea of what that revenue could be, so she knows, how much she can pay her workers and how much to spend on supplies and getting a space. So it helps give you some good information about how to spend money in the business to still make a profit. Another forecasting technique is known as the build-up approach. Here, to project sales, you're estimating the number of potential buyers in a geographic area. And then you multiply it by the average expected sales. You basically make an assumption. So think about it this way. You go on census.gov, census.gov, and you find out that the area has a population size of 10,000 people in your expected location, and survey data showing that 2 in 10 people buy the product. You take a survey, you stand outside and you just ask people, would you buy this? Or you look at, do they buy this? And so then applying that to this population, there's 10,000 people, you say, this 2 in 10 people buy the product, we can expect a minimum of 2,000 of sales. Assuming no repeat customers, $10 per item, that's $20,000 in revenue. So you can use population size data and decide what you think sales could be, applying certain assumptions about the percent of sales you can expect. So for example, if I have a class of 30 students and generally 5 students want to buy a calculator, I can say that 5 and 30 will buy the calculator. I can expand that now and apply it to the 10,000 size population to figure out just how many people might buy calculators there. Another type of approach is executive judgment. Now here the company is using intuition or more than one executives, just knowing the industry well and from experience. This is really only helpful if you're kind of an expert in that area and you do have ample experience. So you being new to a field or starting a new business, this likely would not be the best way to go. Now the Delphi Technique is another forecasting strategy. Here, to project sales, experts actually create initial forecasts, submit them to the company for averaging, and then refine them over time. So here it's a kind of more unique level analysis, and usually you'd use computer software to help generate those forecasts. There's also what we know as a time series analysis. So here you look at the company's historical sales data, try to look for patterns, and that'll help you project what they could be in the future years based on, some things that could be changing. So for example, in the retail field, they have peak periods around like the holiday season, Christmas, Hanukkah, Kwanzaa, that time of year. You'll see more buying going on. And so they can kind of project higher revenues during that time. And based on the prior year, they can say, hey, we have had more of an online market now. We've been running even more promotions during that time. We expect sales to go up maybe 10% more than they were the year prior. So if you have a business that's been in business for some time, using that financial information from before can help you understand what the financial future of the business can be. The last type of forecasting technique is what's known as a market test. Here, just make the product available to buyers, as a pilot, we call it, in one or more test areas. Measure purchases and the responses of the marketing effort. So for example, here we see this double down sandwich. I think this was from KFC. Instead of bread, they used fried chicken on the outside. Well, I'm not a big fan, but I'm sure it tastes good, probably 1 million calories. And so it can be helpful to try it out. See, are people buying the double down sandwich? Well, how many people, what are the sales looking like? And then decide if we do apply those sales from one store to multiple stores, and again, apples to apples, is that a highly populated store with high volume sales? If we're looking at a store in New York City, we want to look at a store in the heart of another city like Washington, D.C. as a comparison rather than one that's more rural. But it can help you understand what the forecasted sales can look like. Moving on from there, we'll talk about another financial statement known as the statement of cash flows. This provides investors and creditors with relevant information about a firm's cash receipts, cash payments for its operations, investments, and financing during a certain period. So again, there's a great video tutorial here. Cash flow is important because we're looking at the funding needed for continued daily operations. And it's really the lifeblood of every company. Many companies fail because they just don't have enough cash on hand. They may own 5 buildings worth millions of dollars, but if they don't actually have cash in their pockets, they might have trouble paying their debts. So going back here, let me zoom in on the screen. The statement of cash flow provides information about money coming in and out of the firm. Okay, public companies are required to publish these, and commercial lenders often require a borrower to submit them to better understand more about the cash situation of a company. So remember, accrual accounting, like we talked about earlier, is this accounting method that records revenue and expenses when they occur, not necessarily when the cash changes hands as cash accounting does. So there can be a difference in what's being reported. For example, I can know I have a customer who's about to pay me $10,000 and it's due in 30 days and it's likely they'll pay, but I don't have those $10,000 in my pocket. And so while I know that I have $10,000 of income coming in, I can't say I have $10,000 cash. So this helps to kind of reconcile, to consolidate that, so you can better understand, like at that moment, I actually have $1,000, even though I think $10,000 more is coming in. It's more accurate in terms of what actual cash I have on hand and what needs to leave the firm. So taking a look at a sample of that, we'll see here, cash flow from operating, investing, and financing activities. And we can see the net increase or decrease then in cash as a result of that. Again, you should be able to let these numbers add up. When you look at a statement, here's $83,000. In accounting, if you see parentheses around it, it means you need to subtract that amount. And here's what's left, $27,000 from operating activities. Here from investing activities, we see there's $9,000 loss because we see those parentheses around it. And same, down here, financing activities, we see a little bit of a profit. So we can see that investing, we've lost some, we've had a bigger investment. Financing, we have some money coming in. Operating activities is where most of the money is coming in from. But overall, we seem to have a positive cash flow at the end of the period. Now, the last statement we'll talk about today is what's known as the statement of owners or shareholders' equity. And this is designed to show components of the change in equity from the end of one fiscal year to the next. Again, there's a tutorial here. Let me zoom in on the screen. This uses information from the balance sheet and the income statement. So if it starts with the amount of equity that we see on the balance sheet at the end of the prior year, then they add net income and cash dividends paid to owners are subtracted, which also is found on the income statement for the current year, to show the new amount of owners' equity, which is then reported on the balance sheet for the current year. So all of these financial statements we've been talking about, not only should you be able to look at kind of the addition and subtraction and make sure those are adding up, but you should also be able to see numbers from one statement matching numbers from the other statement. If we're pulling from the income statement and the balance sheet to help inform the statement of owner's equity, those numbers should all match up. They should be consistent across each statement. So that's another red flag you can look for if you see inconsistencies across them. If your net income reported here doesn't match what you see on the statement, the income statement, then we know there's a problem. You should ask questions and dive deeper. So again, for the purposes of our class, we're not going to build these statements. It's important to understand what to look for in them. We've talked about some red flags to look for in terms of how the numbers add up or consistencies between the different statements. You want to understand which statement helps provide you different information. So for example, a question you might see on an exam for our class is something like, if you're interested in whether your business made a profit or lost money this year, which financial statement would you look to? Now, hopefully, you caught some of those key areas and you know to look to the income statement, because that'll show you the profit or loss over a period of time. Okay, if you looked at the balance sheet, for example, we're not going to get that profit, and we're definitely not going to see it over a period of time like the film. We're just going to see the snapshot, the picture. Okay, so understand the purpose of each of these major statements, generally what it's showing you, and how to look for those red flags for the purposes of our class. Now, on that note, we're also going to talk about financial ratios. Okay, the key to financial ratio analysis, just like with the financial statements, is to compare to benchmark ratios to similar business ventures. Ratios can look very different in different industries. Okay, so you want to make sure that you're looking at apples to apples, similar industries, so that you can see whether or not the ratios are good ratios. So let's talk about the different types of ratios. Again, I'm not as concerned with you being able to calculate these for the purpose of our class. Sure, you can hire an accountant to do that if you don't want to go in the accounting field. I want you to be able to understand what those ratios are telling you in order to make more informed business decisions. Okay, there's a great tutorial on this here. Okay, again, links to more information to help you for those of you that want to dive deeper. So let's talk first about how we can classify ratios. You'll see on the screen there are kind of these 4 key categories. liquidity, profitability, asset management, and leverage ratios. I want you to be familiar with what each of these areas tell us. So for example, with a liquidity ratio, it tells us our solvency ratio, or basically the ability in the near future to pay a debt of a firm. So if all of a sudden I owe $100,000, is that locked up in all these buildings and things I have value, but I can't just take the money out of my pocket and pay it? How quickly can I pay my debts? Again, liquidity. How quickly you can turn something of value into cash. That's what we're looking at when we look at liquidity or solvency ratios. For profitability ratios or margin ratios, we're looking at the success or failure at earning a profit. Okay, and that's big. As a business manager, you want to know how you're able to make money and how much money on the sales that you're making. Now, asset management ratios are things like turnover, efficiency, and activity ratios. We're looking at the effectiveness of a company using its assets. And finally, with leverage ratios, coverage, capital, or structure ratios, we're looking at long-term ability to pay debt as it becomes due. Let's look a little deeper into these key ratios. Now, in terms of liquidity ratios, looking at your ability to meet short-term obligations that must be paid as a firm, we want to see increasing liquidity will avoid emergencies caused by the need to raise funds to repay loans. For example, if you own a clothing store and the machine that actually imprints on the clothing breaks and it costs $100,000 to replace it, if you don't have $100,000 saved up, well, now you've made it so you can't make your product to sell it, but you also need to make your product to make money, and suddenly you find yourself in a bad situation. So, liquidity is a big deal. Decreasing liquidity could force a firm to actually choose between default and borrowing to pay its bills. So the current ratio is mainly used to give an idea of a company's ability to pay back its short-term liabilities. Okay, so things usually within like a year that need to be paid back with its short-term assets. So debt and payables, with things like cash, inventory, and receivables. So you'll see here we're looking at the current assets divided by the current liabilities to get the ratio here. Now, what does this number mean, 2.58? Again, we need to compare to similar businesses in the industry. So the higher the current ratio, the more capable the company is of paying its obligation. If you see a ratio under 1, it suggests the company would be unable to pay off its obligations if they came due at that point. While it shows you the company is not in good financial health, it doesn't necessarily mean it will go bankrupt. Okay, there are many ways to access financing. Again, we want to compare to similar firms as well when we look at this number. Some industries, it might be a lower number, and that might be an okay thing because it could be that, that they don't want to have as much cash on hand because they have a lot of that tied up in some big assets for the organization. Now, a similar ratio is what's known as the quick ratio or the acid test. This looks at the ability of a firm to meet its debt payments on short notice, just like we saw in the current ratio here. Okay, it looks at the amount of assets that can be quickly turned into cash, but it does that without selling inventory because we need the inventory to make sales. So you'll see here the same type of equation, but it's taking that inventory out of the current assets available, dividing that by the current liabilities. So again, companies with ratios of less than 1 can't pay their current liabilities, should be looked at with more caution. Okay, and again, you want to compare that industry to industry. And here we're saying, hey, it doesn't make sense to sell off the inventory, so let's take that out of the equation. Now, activity ratios are really helpful for business managers to make decisions because they're measuring the effectiveness of the management's use of a firm's resources. So as a manager, we're supposed to allocate resources in an effective and efficient way, and these ratios tell us more about how we're doing that. So again, even if you don't want to be an accountant, understanding what these ratios are telling you can help you make better business decisions. So for example, in the inventory turnover ratio, it shows how many times a company's inventory is sold and replaced over a given period. So it can vary widely from industry to industry. Obviously it's going to take longer to sell a car than it's going to take to sell like milk, for example. So we want to look at inventory turnover ratio comparisons from industry to industry. A higher total asset turnover ratio indicates greater efficiency. And we have it going out more quickly. That's great. We have more sales going on. But keep in mind that can be higher for something like milk in the grocery store industry than we would see in like the car or housing industry, where things are going to sit on the shelf longer. It could take up to a year to sell a house. So the inventory ratio here we see, we're looking at Net sales, cost of goods sold divided by average inventory. We see those numbers here, and we see it ends in 5.13. That shows efficiency if we look at other industry standards. So Kroger has an industry standard of 11.4. Nike has a turnover of 4.5. So we want to look at different industry standards, look at that number, and again, that higher total asset turnover rate will indicate greater efficiency, more sales going through, instead of having inventory just sitting on the shelf and not actually selling it. And in some industries, like the technology industry, that can be a problem. A computer sitting on the shelf for 3 years and not selling quickly enough, that can mean that it's depreciating in its value, just like a car depreciates in its value. So it's important to understand what this turnover ratio is and maybe make changes in the business. You might want to run a promotion if you have something sitting on the shelf longer than it should be, and you might start losing some of its value if that's the case. Just like milk, goes bad being on the shelf. Your asset turnover ratio indicates how much in sales each dollar invested in an asset generates. So generally, the higher the ratio, the better it's going to be. It implies the company's generating more revenue per dollar for each of the assets it has. But since this varies widely from industry to industry, comparisons are only meaningful if they're made for different companies in the same sector. So for example, in the telecommunications field, they have to put a lot of money into that infrastructure in order to build out their telecommunications systems. So we're looking at how much money they can generate in sales. They're going to have more assets in place. So that's something to think about. Now, receivables turnover ratio is really interesting. As a manager, you should be excited about this one. This measure is used to quantify your firm's effectiveness in extending credit and collecting debts. So, for example, you're a law firm and you have a client who, you've billed them $10,000. Well, that $10,000 is only valuable if you're able to collect it. And this isn't just about are we able to collect it, but how quickly we collect it. Obviously the time value of money, it's better to have the money sooner than you're able to invest it and maybe earn money off of it, or you're able to pay your cash debts sooner. So that $10,000, are we collecting it? If we're not collecting it from 20% of our clients, we could really be hurting our revenues. You might want to think about a better collections process, like maybe charging customers, having them pay up front, to avoid that type of problem. So ultimately, if I bill a customer $10,000 and they just keep not paying it and it goes to collections, especially in the legal field, it might even look bad to be suing your client to try to get that money back. And so that's something to think about. One of the changes I always recommend, especially as your firm grows, you might not care if someone's paying in 30, 60 days, but if you're making millions of dollars, then you want to start thinking about, wow, a 60-day payment versus a 30-day payment, I have $1 million 30 days sooner. I can invest that and actually earn some money on that more quickly. So a low ratio implies a company should reassess its credit policies. Make sure that you're collecting timely and that you're, earning more interest for the firm. Because again, if we can get money, get it sooner, we can earn money on that money itself, which is pretty cool. Now, profitability ratios are also really big for a manager in a business. Even if you don't want to be an accountant, it's important to understand how you make money for your business. So this looks at the overall financial performance by evaluating the ability to generate revenue, money coming in, beyond the expenses going out. So the first is what's known as the gross profit margin. This indicates the percentage of sales dollars available for expenses and profit after the cost of merchandise is deducted from sales to measure how much out of every dollar of sales a company actually keeps in earnings. An easy way to put that, a little more simply, going back to the stapler, if I charge a customer $10 for this stapler, okay, and it costs me $6 to make it, there's $4 left that are going into my pocket. There's a 40% profit margin. Now, that could be good. Again, it depends on the industry. Walmart, for example, will have low profit margins. They might charge only $7 for this stapler. It costs them $6 to make it too. They only make $1 each time they have a sale. That's only a 10% profit margin. But their sales are so high, their revenues, the amount of money coming in, they have so many more customers, it's okay that they make less money on each stapler because they sell more staplers. So the gross margin, again, varies between industries. So the higher the margin, the better. Obviously, if I can sell something and have more money, more profit in my pocket each time I sell it, that's great. That can be helpful for investors to see, like, wow, just one sale and they make $4, that's huge. But then also keep in mind, it might be something where you want to lower the price, have more customers, and still make good profit, not as high of a margin. So gross profit margin can be really, really helpful for a manager in determining how to set the sales price and how to lower expenses to make sure you're maximizing the amount of profit on each sale. Net profit margin, we're talking about the same thing here. Okay, when we talk about gross versus net, net profit indicates the profits per sale dollars after all expenses and taxes. So here we're also taking taxes out. Okay, you have to pay, our Internal Revenue Services, Uncle Sam, we have to pay them some money. So net is going beyond gross profit and saying now taxes are paid. Here's what's really left to go into your pocket. Finally, the return on stockholders' equity is another key area to look at as a manager. It looks at the percentage of profit after income taxes that the corporation earned on its average common stockholders' balances during the year. The return on equity, again, is going to vary, and the higher the return, the better. We want to be providing people who have provided money to the firm, hoping to gain profits in return, more profits. The last area of ratios that are important are what's known as leverage ratios, measuring the extent to which a firm relies on debt financing. Here, if you as a manager has really relied on too much debt, you've taken out too many loans to finance the firm's operations, there can be problems in meeting future payments and repaying those outstanding loans. So that's where we look at what's known as the debt ratio. This indicates the percentage of a company's assets that we actually get through debt. So again, while I can have a $20,000 car, if I had to get an $18,000 loan, my debt ratio is going to be very, very high. We're looking at the total liabilities compared to the total assets. So yes, the company has a lot of value, but they owe a lot on that. It's not worth as much then, as we talked about earlier with the accounting equation. So if you see a ratio greater than 50%, it indicates a firm is relying more on borrowed money than on money they actually have. So even though they have a lot of assets, they owe so much on them. They owe more on them than they have in them. There's less value there. So here's the types of questions you might see in our class for our purposes. Remember, I want you to understand what those ratios can tell you to help you as a business manager make more informed decisions. So for example, to determine whether customers on average are paying your business invoices on time, which ratio would you look to? Here, this is that receivables turnover we talked about earlier. Again, you can see whether or not that's something that's and how quickly. And that can mean one can change the policies. Maybe start making people pay invoices, pay the bills for the firms more quickly. The next one, to determine how much money goes into your pocket each time you sell a product at your business, which ratio? Here, this is the net profit margin. That would be after taxes, or the gross profit margin would be before. But we're looking at how much money each time you make a sale actually goes into the organization, really into your pocket, how much profit's there. To measure the extent to which a company relies on debt to finance their business, which ratio do you look to? The answer here would be the debt ratio we just talked about. Okay, so again, while you might have a lot of value in a business, if you owe a lot of money, it's less valuable than someone who has invested more and doesn't have a lot of debt they need to repay. If you want to determine if a company can quickly pay upcoming bills, what ratio should you look to? Liquidity ratios will tell us how quickly a firm can take its assets, turn it into cash, and pay off short-term bills. And again, that can be important in case like something breaks, a major piece of equipment breaks. You are able then to replace that equipment so you can continue operations. Now, if you want to learn more about some of the information we talked about today, there was additional tutorials about each key area we talked about throughout the presentation for financial statements and ratio analysis. You can also go to www.accountingcoach.com. I really encourage you to go there. It's a free resource that gives you a lot of information for accounting and can be really helpful as you continue in your accounting classes to provide additional practice and more information. Also, if you're interested in learning more about investing, again, all the information we talked about today can be helpful as a business manager, but also, if you start making that big money and you want to invest it so it can be earning money on its own, you want to think about investment strategies. There's actually simulations you can use with pretend money so you don't get yourself into a bad situation to try that out. So this is known as fantasy investing. You get to practice buying and selling stock without the risk of, losing your own money. So one of them is what's called Wall Street Survivor. The other is Investopedia.com/simulator. So if you're interested in investing, I encourage you to do this kind of practice investing first so you can see, whether or not you might be successful on the market. Now, what about your personal finances? There's actually free access to more than 20 online training modules available here, covering topics from savings, retirement planning, mortgages, insurance, and credit. And it's really important to help for you to understand personally, not just for your business, how to build good credit, and what it means when you're taking out a loan. Something like a student loan or a loan on a car, a loan on a house, what that interest means as it compounds, you end up paying a lot of money. So you might buy a $500,000 home, but actually pay almost $1 million by the time you pay off that 30-year loan. So understanding your personal finances, when to rent, when to buy, when something's a good investment, when it might not be, is a big deal. Because of that, we actually offer what's called Personal Finance, BSAD 111, at the college. I encourage you to take one of these classes. Some of them are actually financed through a grant, so they'll actually pay for it. It could be a free class for you, so I encourage you to look into that. You can always email me to ask about that class. That's a good elective that transfers to a lot of schools, and really one I think is important. You take on a lot of debt throughout your life. If you do become successful in your career and you are making money, learning how to use that, what to do with that money, how to build good credit for yourself and how to not get yourself in a bad situation. We focus so hard on getting the degree and getting that dream job and the right career, but when you are earning the kind of money you want to be earning, learning how to use it well and how to invest it or make sure that you're earning on that money and not getting yourself, kind of over your head in debt you can't pay, it can be really valuable. So I encourage you to learn more about your personal finances. In the learning module, there's a great overview on that, and again, you have these tutorials to help as well, and you also have classes like BSAD 111 to help learn more about this key area for your personal life and on the job. That brings us to the end of our financial statements and analysis overview. I hope this was helpful to give you some information from a business perspective and how the language of accounting can help you on the job. Thank you.